This is Dave Bolduc with the Bella Group. Welcome to my real estate update. Today is July 15th, and although I've hit this several times and I feel like I'm becoming a broken record, we're going to hit it again. Is there a housing crash coming or not? I've heard a lot of comments about it. People keep telling me about it. So we're going to dig into that. But first, YouTube algorithm, please click the like button, subscribe, ring the notification bell. And again, I know you guys know who you are. Tell me offline that, hey, I watched your videos, great. I thought this, I thought that. Throw it in the comments. I appreciate it, and maybe other people will appreciate it too. So throw those in the comments, and that also, it helps with the more interaction. YouTube shows more people stuff. So we got about 6,400 houses active right now, creeping up just a little bit, a couple hundred a week. That's great, so we're seeing a little bit more, but it's still very low inventory. About 900 new construction, that's great. Still very low, but it's better than nothing. I know inflation is causing problems with that, but we just got to keep moving there. Remember, about 35% of those houses that are on the market, they've been on there for a long time, greater than 50 days. And especially in a market like this where things are moving so quickly, that's saying something. And typically it has to do with the condition of the house. There's a little TLC, and this could be an HGTV moment for you. So if you're interested in doing a renovation loan, it's a great opportunity there. So 54,000 homes sold last year. We're halfway through the year. I'm estimating that we're going to be at between 49 and 50,000 this year. Why is it lower? Well, there's nothing to sell. There's inventory so low that there's nothing to sell. And on top of that, prices are going up, interest rates are going up, so demand is coming down. Now, I want to emphasize, because I've heard people say this, demand's dropped off, the whole market's going to crash. So if supply is here and demand was here, supply is here and demand's like here. And these are relative, right? Not exact. Don't measure it and tell me that, this is that, this is the other. But the point is, demand has come down, but it hasn't done this. Supply isn't higher than demand. So we're in a situation where it's still a seller's market, and I really don't see that changing anytime soon. So as I said, I'm estimating about 50,000 homes sold this year. If we break that down by month, it's about 4,200 homes. So we have about 6,400 homes on the market right now. Should be selling about 4,200 per month. So that's about a month and a half of inventory that we have on the shelf. Still extremely low considering we like to be in around the 6-month range. So let's jump into this now. And I've shown this slide before. Over the last 40 years, 6 recessions, 4 of them, housing prices continue to increase. 2 of them, 1991 and 2008, they went down. 1991, almost 2%. Just some natural variation there. I'm not too worried about that. A lot of other things going on at that time. And then in 2008, almost 20%. But in that time period, the housing crash is what caused the recession. It's not the other way around. The recession didn't cause the housing crash. So if you look at this chart, at no point has a recession caused a housing crash of any significance. They're not correlated as of showing this data here. Talking about recessions here, okay, why am I saying that? Well, there's a lot of people speculating we're in a recession right now. GDP for Q2 is out on July 28th. The rule of thumb, 2 quarters of negative GDP means a recession. Well, Q1 was negative. So if Q2 is negative as well, and that's what the indicators are showing right now, then we'd be technically in a recession, or at least according to that rule of thumb. So now we kind of take the recession off the table, at least for now until someone else brings it up. What's the latest data point that people are jumping on and saying, oh my goodness, this is showing we're going to have a crash? It's number of homes for sale. So Realtor.com put out a note saying that homes for sale are up 18.7% year over year. I have 2 problems with that. The first problem, and that's across the U.S. The first problem is you're looking over too big of a geographic area. The second problem is you're looking over too short a period of time. So neither one is good. Real estate is extremely local. So you have to, although macro trends do give you a good indication of what's going on, you have to look in each area. So I live in Connecticut, so I'm worried about Connecticut. Let's talk about Connecticut. The number of active homes for sale in Connecticut year over year, June 2022 to June 2021, down 24%. Not up 18.7, down 24%. And I got this chart here shows it. The last time we actually saw this low of a level of inventory for sale was pre-2003. The data goes back that I have access to goes back to 2003. So remember, real estate is local. Keep an eye on the macro because there are trends that can influence the local, but the local market is critical. You really have to stay with it. So again, let's take a look at this chart. So 12,253 in June of 2021, 9,294 in June of 2022. And you'll see those peaks and valleys. That's the real estate market being cyclical. The low points are winter, the high points are summer. Every year. You can see it going back to, this is a 10-year chart. So you can see going back, and you can see we're on a strong downtrend. Now, the reason I say you got to look over a longer period of time is let's go back to about 20 years rather than only 10 years. And you can see here, it's a much different chart, isn't it? It's the same data. It's just going back to 2003. And you can see we were down in the like 10,000 range on average, homes for sale. And we went all the way up into the 25,000. Well, what was going on there? That was the 2008 market bubble, right? Where we sold a ton of homes, we built a ton of homes, and then everybody realized they needed to sell them, and they put them all on the market. And that pumped up the volume, and then that volume has dropped off over time. Why is it dropping off? Well, because we stopped building homes at the rate we were building them before. We're building about half the rate that we were back before the crisis. And on top of that, there's the larger population, more people are buying them, and more people are staying in their homes longer. So those things are all driving the inventory down. The reason I'm showing you this slide is just to give you an idea of why I'm saying you have to look over longer periods of time. Now, I understand the market in 2003 versus the market today completely different, but if you're going to look backward, you have to look over a long enough period of time to see all the variation in what's really going on in these numbers. Rather than just give my opinions, I wanted to give a completely independent source that's saying pretty much the same stuff. So this is from Forbes Advisor. It's an article. The link is right there, and I'll put it in the description. Great article, quick read too. It's not very long, but it's got a lot of the same points that I'm talking about. Demand is still strong, although there are some things tempering it. You know, the increased mortgage rates and the inflation. Supply is very low, and it's not keeping up with demand, which that's just a standard supply and demand thing. And then borrowers are less likely to default. And I talked about that as well. They've got more equity. They are much more rigorously screened now than before 2008 by banks. And so that stronger buyer is less likely to have a foreclosure. And so I don't think we're going to see the foreclosure wave that we saw after the big crash in 2008. It does highlight some warning signs, some of the same signs that I talked about. More people are starting to use ARMs. The interest rates are going up. Prices are very high. And if people continue to bid prices up, we will get to the point where we're in a bubble. We're just not there right now. So I highly recommend taking a look at this article. It gives you some good information, and for me it corroborates what I'm seeing in the market. So I feel good about that. So let's talk about the primary mortgage survey. I can't speak right now. The primary mortgage market survey. We're at 5.5%, which is better than what we were at. We were up over 5.8 for a little while there. The Fed is expected to hike the Fed funds rate between 3/4 of a point and a point. It could be as much as 1.25. Previous expectations were 1/2 to 3/4 for July. So it'll be interesting to see what's going on. Why is that expectation going up? CPI, the one of the measures of inflation, came at 9.1, much hotter than what was expected of 8.7. This indicates the Fed needs to do more and bigger rate increases to tame inflation because they haven't tamed it yet. There's a lot of people speculating that June is actually the peak, that commodity prices, gas prices are coming down. So we'll see when that data comes out, and I hope they are right. But the expectation of higher interest rate or higher Fed fund rates doesn't bode well for mortgage rates, at least in the short term. And hopefully interest rates do come back down as inflation settles out. And the final slide I want to go over, headed every time. This is just a chart over the last 50 years. Remember, I like to look at things over a longer time frame. 5.5%. It's not as good as the low threes that we were in a little while ago, but it's certainly better than what we saw in the 70s, the 80s, and the 90s. And even the 2000s were still below that. That's all I have for right now. Hopefully you got some value out of this, and hopefully I'll see you next video. Have a great day.